All right, let's talk more about this new liability called bonds payable. So if the company's board of directors decides, yep, I've weighed the advantages and disadvantages, I want to go ahead and sell stock to those investors, great, let's do the journal entry to record a bond issuance. Okay, so remember what's happening? We're getting cash. So debit cash. Let's say this is on January 1st. Just like with a note, when we took out a loan, we debited cash and we credited note payable. Now it's a bond payable. Okay, let's say it's for $1 million. Bonds are always recorded at par value. So this bond would be $1 million par. We said corporate bonds pay interest every 6 months. So let's go ahead and do the journal entry to record interest paid to bondholders. Let me give you some data over here. So our par value, we said, for this bond is $1 million. Well, let's figure out what our interest rate is. Let's say it's 10% to make things simple. And let's say the life is 5 years, right? Because it's a long-term liability, got to be more than 1 year. All right, the nice thing is we are going to use the same formula I showed you last chapter to calculate interest, P-I-T. Okay, this time P stands for your par value. This is still your interest rate on your bond. This is still time. Remember, 12 is always your denominator. And since we're paying interest twice a year or every 6 months, you can have 6 as your numerator. Your accounts, interest expense, and cash. So go ahead and do your calculation here. 10% times, we can just say 1/2. Or 50,000. And that brings me back to that disadvantage, right? If you have to pay interest every 6 months. So the company has to make sure they have $50,000 lying around every 6 months to make this interest payment. All right, they're going to repeat this journal entry. Repeat 2 times a year for the life of the loan, which is 5 years. Then at the end of the 5 years, let's say January 1st, 5 years later, the par value is due. We have to repay the par value. Just think about when you pay off any liability. Decrease the liability by debiting it. Decrease your cash with a credit to record payments of par value at maturity date. Okay, $1 million. There you go. Now you know your journal entries for a bond issuance, for interest, and for payment. Lovely.